Hello, and welcome back to my channel, the Real Estate Invest Guide. I'm thrilled to have you here for part 2 of our previous video, How to Obtain Citizenship by Real Estate Investment. If you missed the first part, don't worry, you can catch up right over here. In our last video, we took a deep dive into citizenship by investment, CBI, programs, and highlighted some of the significant drawbacks associated with them. Today, we're turning our attention back to this topic to uncover even more nuances and drawbacks of CBI programs. Let's kick off with the second drawback, the heightened scrutiny and regulatory hurdles faced by individuals obtaining citizenship through CBI programs. There is risk of increased scrutiny and regulatory challenges for citizens acquired through CBI programs. Some countries, particularly those in the European Union, have raised concerns about the potential abuse of CBI schemes for money laundering, tax evasion, and other illicit activities. As a result, individuals who obtain citizenship through CBI programs may face closer scrutiny from financial institutions, tax authorities, and immigration agencies, which could impact their ability to conduct international transactions or travel freely. The third disadvantage on the list is that citizenship acquired through investment may not confer all the rights and privileges enjoyed by natural-born or long-term residents of a country. Some CBI programs impose restrictions on citizenship rights, such as limitations on political participation, eligibility for government benefits, or the ability to pass citizenship to future generations. Prospective applicants should carefully review the terms and conditions of the CBI program they are considering to ensure they understand the implications and limitations of the citizenship they seek to acquire. Now that we've covered a significant portion of the discussion, let's transition to exploring factors to consider when selecting a real estate investment program. When selecting a real estate investment program, there are several key factors to consider to ensure you're making an informed decision. The first factor to consider is the program's investment focus. Studying a country's investment strategy is very important. Is it primarily centered around rental properties, fix and flip ventures, commercial real estate, or perhaps some other niche within the real estate market? Understanding this aspect is crucial as it dictates the nature of returns, time horizons, and risks associated with the investment. For instance, if you're seeking stable, long-term income streams, a program focusing on rental properties might align better with your goals. Conversely, if you're comfortable with higher risks and potential short-term gains, a fix and flip strategy could be more suitable. So, assess your investment goals and risk tolerance against the program strategy to ensure compatibility. The second factor to consider is the program's adherence to legal and regulatory compliance. It's crucial to ensure that the program operates within the bounds of the law, holding the necessary licenses, registrations, and compliance with securities laws. This means making sure it has the right licenses and registrations, and that it obeys the laws about selling investments. When a program follows the rules, it helps protect you as an investor and lowers the chances of running into legal problems later. Before you invest any money, it's important to do your homework to make sure the program is doing everything it's supposed to under the law. This way, you can feel more secure about the investment being safe and trustworthy. The third factor to consider is market analysis. Conducting a comprehensive market analysis helps to evaluate the potential success of the program within its target market. This involves studying factors like supply and demand trends, economic indicators, and demographic shifts. For example, let's say you're considering a real estate investment program in the United States. You'd want to analyze housing market data, employment rates, population growth trends, and local economic factors impacting the specific regions where the program operates. Understanding the dynamics of the market is crucial for assessing its viability and potential returns. By analyzing these factors, you can gain insights into the market's growth prospects, competitive landscape, and potential risks. Moving on to the fourth factor. The fourth factor to consider is evaluating the program's transparency and communication practices. It's essential to have clear insight into how your money is being invested, receive regular updates on performance, and have access to the management team for questions and concerns. Transparent communication builds trust and ensures that investors are informed about the progress and status of their investments. Look for programs that provide comprehensive reports, hold regular investor meetings or updates, and have channels for addressing investor inquiries promptly. Let's move on to the fifth factor. The fifth factor is to compare the costs of the investment with the potential returns. Examining the costs in relation to potential returns is fundamental when considering investments. This comparison serves as the cornerstone of prudent financial decision-making and risk management. Costs encompass a range of factors, such as initial investment amounts, transaction fees, ongoing management fees, and potential taxes. Each of these elements can erode potential returns, underscoring the need for careful scrutiny. On the flip side, potential returns can be diverse, including capital gains, dividends, interest payments, or rental income, depending on the investment type. It's crucial to assess not just the potential upside, but also the associated risks. Investments with higher returns often entail heightened volatility or increased exposure to market fluctuations. Therefore, evaluating risk-adjusted returns is essential for making well-informed decisions. The sixth factor to consider when evaluating an investment program is understanding its fee structure. Understanding the fee breakdown of any investment venture is pivotal, as it directly impacts your overall gains. These fees typically encompass management fees, performance fees, and sundry expenses. Management fees cover the ongoing oversight of the investment portfolio, usually calculated as a percentage of the assets under management. Performance fees, on the other hand, entail extra charges contingent upon the fund's performance, often a percentage of the profits earned. Additional expenses might encompass administrative overheads, legal fees, and marketing expenditures. High fees can gradually diminish your returns, potentially undercutting gains and diluting the efficacy of your investment strategy. Thus, it's imperative to meticulously assess and compare fee structures when evaluating investment prospects to ensure they harmonize with your financial objectives and risk tolerance levels. In summary, securing citizenship through real estate investment opens doors to citizenship in a foreign land. This journey typically entails committing a substantial sum to real estate ventures sanctioned by the host country's government. Although the process varies based on the destination, key steps involve selecting an eligible investment, meeting financial prerequisites, and navigating through legal and bureaucratic channels. Through astute real estate investments, individuals gain access to perks like visa-free travel, expanded business horizons, and the prospect of dual citizenship. However, it's imperative to conduct thorough research on program requirements and ramifications, considering the significant financial stakes and legal intricacies involved. In essence, citizenship through real estate investment offers an enticing avenue for those seeking to broaden their citizenship portfolio and enhance their global mobility. If you found this information valuable, don't forget to spread the word. Like, share, and subscribe to stay updated on more content like this.